So, hi everybody, this is Asahab and Giacomo, and today I'm with Lawrence Fuller. He is the founder of Fuller Asset Management. So, Lawrence, please introduce yourself and then let's get into the content of today.
Sure. Thanks, Giacomo. Uh, yeah, I'm the principal of Fuller Asset Management, which is an asset management firm, and I'm also a contributing writer on Seeking Alpha's financial website. And lastly, I'm a portfolio manager at Dub, which is a new fintech that's just recently launched. So appreciate the opportunity just to talk about my outlook for the macro economic landscape in the U.S. and then how that relates to the broad market for the months ahead, since we've had a great start to the year. Want to hopefully that'll continue, but there are a couple things that I'm a little concerned about, but overall, I'm pretty optimistic. So, so I'm going to start just with this first slide I have up, which to give you a little bit of a background on the strength that we're starting the year with, because the last year, maybe two, there's been a lot of pessimism and talk about recessions in the U.S. And it hasn't happened. And I think this chart here, which shows the excess savings that built up in the economy, in consumers' pockets post-pandemic, is really what's fueled us up to this point. You can see here back in the peak was really in August of 21, but this mountain of cash is what was spent through most of 2002 and into the end of 2023. And you note here, this is it's not there's lots of estimates as to how much remains, but there's still some remaining as we enter 2024. And the significance of this is that when inflation was running at 9% in the summer of 2022 at its peak, the savings worked as an offset for the loss of income people were having, because wage growth was about half the rate of inflation back then. So it really helped us out. And what's the positive development that's just happened, if I go back up here, as the savings are running out, so is the rate of inflation decline. And so now we just started to realize what's called real wage growth, where the rate of inflation has fallen below the rate of wage growth. So consumers now have purchasing power that they didn't have when in the summer of 22, when those savings were helping to offset that. So that's a real important factor. And another thing that I want to touch on in terms of the health of the U.S. consumer, who is really what drives about 70% of our economic growth, is that the balance sheets for consumers are very, very strong. There's lots of talk about how much debt there is in the United States, student loan debt, credit card debt, but the amount of debt really isn't as important as the ability to service the debt. And what you see at this top chart here is the percentage of disposable income that's being used to service outstanding debt. And right now, it remains near multi-decade lows. It fell really, really low back when we had peak savings, excess savings. So what's really done is it's come back to pre-pandemic levels, but we're flirting with a rate around 9.6, 9.7%, way below anything you've seen over the last 40, 50 years. And then on top of that, delinquency rates, which naturally go up as an economic expansion goes on, they've risen quite a bit, but they're still rising. If you look down here to the bottom, again, historically low levels. So you have consumers with real wage growth, and you have very low cost to service debt, and that's what's continuing to drive the U.S. economy into 2024. And here's the other tailwind: is that inflation has come down so rapidly, nearly as rapidly as it rose, that we have, and I've got two charts here, but I'll talk about this first one, which is we have two ways we measure inflation in the U.S. There's the Personal Consumption Expenditures Price Index, and there's the Consumer Price Index. And so the Federal Reserve, their preferred method is using the PCE price index. And if we look at the PCE in the last 2 quarters when the U.S. reported GDP, and we annualize it, we're already at 2%. So the Fed has reached its target. And if we look at another method here, which is the consumer price index, that's been running at 2% since September of last year when we exclude shelter costs. And so the one thing left here, the one piece of the puzzle to get us down to 2% across the board is to bring shelter costs down, which is it's a combination of how fast home prices are going up as well as rental rates. And we calculate rental inflation in a strange way here because we look at it on a trailing 12-month basis. So rents that someone was paying 9 months ago are factoring into the equation of what rental inflation is today, which is it's come down dramatically. In a lot of cities, it's rents are declining. So as those new lower rental rates work into a 12-month average, it'll bring that rental inflation down, and we should be at 2%. I think this summer, if not early fall. So these are all huge tailwinds for the U.S. stock market. And the only thing that we have to worry about in this next slide is that in 2023, the economy grew at just a breathtaking pace compared to what people were thinking was going to do. But the rate increases that the Fed put through the summer last year, those have a lagging effect on the economy. So they're going to slow growth this year. And that's why the estimates here, you look at the first quarter of 2004, the estimates are all below 2%, 0.9, 0.5, 1, 1.3, gradually picking up. Trend growth is usually around 2%. So we're dangerously low to where, we could see a recession if something really bad happened, right? And this is where, as an investor, you want to be looking at what can go wrong as much as you want to look at what can go right. And so for me, the one thing that could really go wrong is Fed policy. And this is where the Fed funds rate is today, all the way up here at 5.5. And it's near prior peaks, but it's policy is really restrictive right now. And that's because the Fed wants to bring inflation down to 2%, but they need to start lowering the rate well in advance of hitting that 2% because the rate cuts will work with a lag. So we're still feeling rate hikes from last summer, to be honest. Those take a long time to work their way through the economy, through the system. So I'm a little worried that the Fed waits too long. And I was hopeful that they might cut in March and begin this rate cut process, which is would be another tailwind for the market. But if they wait till May, it could still be okay. But I think any further, we're going to have some trouble, and it's going to be a red flag for me. And one of the things that they're looking at, which is potentially delaying their start of rate cuts, is this big uptick we had in employment, job creation last 2 months. Now, I think this is an anomaly. I think it's, we saw prior spikes back in here ever since peaking in job growth. You see a lot of ups and downs, but there's other factors involved right now that say the labor market's continuing to weaken and soften. And so I don't think these ought to be used to determine when we start lowering rates, but it's a factor the Fed's considering. So moving on here, I'm going to show you what for me is sort of it's the most important barometer on economic activity in the U.S. in terms of when things may be going wrong. And it is a measurement of retail sales on a year-over-year basis. So it's the year-over-year retail sales growth rate, but it's adjusted for inflation because GDP is adjusted. Real GDP is what we're looking at. And so this might be hard to see on the top chart. See if I can expand it a little bit. What you notice here is year-over-year retail sales. When they turn south, that's when we've had recessions. Literally coincidental with when the real rate year-over-year drops. Same thing here. You see it start to drop right in 2007. We saw the same thing right before the pandemic. Now, there's an anomaly in here, which is this little dip right here, which I've made it look a little bit larger right here in this bottom chart. Back in April of 2003, retail sales declined 3.5%, and everybody shouted recession. It's a recession, okay? But the reason that's an anomaly is that after the pandemic, consumers started spending a lot of money on services, almost exclusively. They were going to bars and restaurants. They were taking road trips. They were throwing parties. I mean, they wanted to be outside, right? They weren't buying cars, washers, dryers, appliances. And so retail sales is predominantly goods purchases, not services purchases. So at this particular time, I looked at this as an anomaly and instead relied on the year-over-year change in overall consumer spending, the personal spending numbers versus just retail spending, and that didn't turn down. So this was a head fake. But as we work into this next year and things start to rebalance a little bit more, people are back to buying houses, fixing up their homes, making larger purchases, spending less money out in restaurants and bars. This is going to become an indicator for me that I'm going to watch very closely in the year ahead. Let's see what we have here. So this is this gives you an idea of what happened last year, and I think it's a good model for this year. So last year, right around this time of year, we had about a 7% decline in the S&P 500. We call that a pullback. Anything between 0 and say 10%. And then we had another one in July. That was a full correction at 10%. And the one that came earlier in the year in the first quarter relates back to when I talked about how retail sales were starting to turn down. The Federal Reserve was speaking very hawkishly about inflation. And I think that if we have a period of in here where we see a pullback, which is much more likely than a correction in the market, it's probably going to come between now and when the Fed meets in the middle of March. So we call that about what's in the next month to 5 weeks. We'll see. I mean, markets are really extended. We had a huge run up, but that would be the excuse that I can see people wanting to take some money off the table because of the uncertainty about what they're going to do with interest rates. And it'd be a healthy pullback if it were to happen. So that's really my main concern right now is not the economy, not corporate profits, but Fed policy. And looking at the stock market here, this is just a chart of the S&P 500. What's the downside? I mean, we've had just this meteoric, parabolic run from November to December, in January, now February, and we're up again today. It's really been a straight up move. We're significantly above the 200-day moving average down here, as well as the 50-day. Even a pullback to the 50-day would barely be, it wouldn't be a 5% pullback. But that's pretty realistic in terms of what I see could happen between now and getting through that March Fed meeting. And if it happens, I think where the risks lie are in the most popular stocks, which are these Magnificent Seven, and you could broaden it out to say the top 10 stocks in the S&P 500 that everybody loves because they seem impenetrable right now. They've had phenomenal earnings reports, with the exception of maybe Tesla, and they've outperformed the broad market so dramatically. The top 10 companies now account for about 35% of the S&P 500, and so there's a lot of risk there. And this is an example of what the performance looks like for the overall market. And then underneath the hood of the market, and last year the S&P's up 25%. But if you take the equal weighted S&P, take all 500 companies, and just let's say they were just 2% of the index, rather than having the Magnificent Seven account for nearly 30% of the index, the return falls from 25 down to about 7, which is a little bit below that of the small cap index at about or a little bit above that of the small cap index at about 6%. So there's two ways to look at this. There's lots of opportunities in the market right now because there are lots of stocks that have not they haven't shown up for the party yet. Like today, arguably you could say it's happening because the Russell 2000 is up 1.5% today, and the S&P, last I looked, was unchanged. And so the Magnificent Seven are really sleeping today, and the rest of the market's showing up. And that's the kind of rotation I think we need to see another big leg up in the market. So, you know, here's another thing I've been honing in on the last 6, 7 months that I think gets underappreciated in terms of the potential drawdown in the market if something goes wrong. There's $6 trillion right now in money market funds in the U.S. And not all that is stock money that's sitting on the sidelines waiting to buy the next dip. I'd say maybe 1 to 2 trillion of that might be money that's happily earning over 5% in interest because of the Fed funds rate, but would like to own another kind of asset. It wants to own a bond. It wants to own a stock. And so when the Federal Reserve starts to lower the Fed funds rate and we fall below 5 to 4.75 to 4.5, which is sort of where the consensus view is will be later this year, the money market rates, and I participated in this. I have cash that's in these money market rates, and it's really nice to earn a risk-free 5.3%. But when that falls to 4.9, 4.5, the impetus is going to be to put it somewhere else. So I think this is going to be it's going to be a safety net for the market all year long that minimizes any drawdowns. And I'm going to finish up here with one last. This is a really interesting technical development that occurred in mid-January, and it's from a technician that I follow. His name is Wayne Whaley. He has this indicator called the turn-a-year indicator. Okay, and it measures how the S&P 500 performs from November 19th through January 19th every year. So it turn a year in that you're looking at performance from the previous year into the new year. And when that return is greater than 3%, the stock market tends to do exceptionally well in the 12 months that follow. And so what this chart shows is every occurrence, all 37 occurrences, including the one that just occurred this past January 19th. And I like the odds here because 35 out of 37 times the S&P has finished higher, and the average gain's been 16.5%. So the only 2 times we saw a negative return was in 1987, which was an unusual year, and then back in 2018. But those drawdowns were only 5 and 7%. So, I like to focus on the fundamentals, but I'm also a technician. And what I love is when I've got a fundamental outlook that's very optimistic, and then I can go look at the technicals and find things like this that say, hey, this looks like it's going to be a really positive year, because then you feel really confident in your investment strategy and your outlook for the market. So I think that I think this is going to be another good year. I'm pretty excited. So.
Okay. So I have a few questions about all the things that you have talked about. So first and foremost, so you talked about Fed policy, and I want to focus on that. So basically, is the market discounting a rate cut in May, and anything different from that? Could that be could that possibly move the market big time, either if it's sooner or later?
Well, the consensus view from the market standpoint was that we were going to have a rate cut beginning in March, and the Fed pushed away. They pushed back on that pretty hard, and they often do because they're trying to manage expectations, inflation expectations. They don't want the market to surge, because when the market surges, that can be inflationary in and of itself. You inflate financial assets, people feel wealthy, they go out and spend more money. So up to this point, the market has digested that pushback to May pretty positively, because they think the consensus thinks that the economy is so strong it can handle it. I'm not quite sure the economy is that strong, but what happens then is that if the Fed doesn't begin cutting in May, and we start to see some economic weakness in the numbers, that can lead to a pullback. That can lead to a drawdown in the market. All it would take is a weak employment number, a weak, any of the high frequency economic data, a pickup in unemployment claims, or, for example, we have two broad measures of services and manufacturing activity called the ISM, the Purchasing Managers Indexes. If one of those monthly numbers were to come out very weak, that could instigate a sell-off, because the market's going to say, hey, we told you should have started cutting rates in March. Now you're going to wait till May. We may see growth slow a little more than we wanted to,
Okay, okay. And talking about the job market, the results that you mentioned that were better than expected, uh, is it due to the change in industrial policy, namely the Inflation Reduction Act, or is it something else? And to what extent does that play into the equation?
Well, it could. I mean, everything has some incremental impact. So sure, that policy may be having an
Because
impact.
from our point of view, it's a big change in industrial policy that we haven't seen from the US in quite a lot of decades, I think.
Yeah, no, I think it is. You're not really seeing it yet. Manufacturing is just starting to turn around in the U.S. It's been in a recession. The manufacturing sector in the U.S. is only about 10% of the economy, so it's relatively small compared to the service industry. But it's been in recession for 15 months, and so we're finally seeing new order growth in manufacturing. That segment of the economy is turning around. That could lead to a big increase in employment. Um, the there's lots of different ways to measure the employment in this country, and the jobs number that we report in the establishment report, which is there are other surveys. For example, there's a household survey that is a little more what's a lot more sensitive to jobs that are created by small businesses that aren't surveyed, the self-employed, things like that. We've been losing as many jobs in the household survey as we've been gaining in the establishment survey. So there's some offset to that. And so, people aren't leaving their jobs right now at the same rate they were. They're more reluctant to try to switch jobs because they're not realizing wage gains. That tends to be also another indication that the labor market's softening or weakening a little bit. But we still have lots of job openings. And even though those are coming down, the reason typically those jobs can't be filled is we don't have the skilled labor to fill them, So it's the job you want the labor market to slow down because you want inflation to come down, but just not to the extent that it's a negative,
Okay, okay. And talking about the difference between the Magnificent Seven that you talked about and the rest of the market, do you think, in your point of view, what could possibly justify the difference, the big difference that we've seen? So I'll mention one of the conversations that I've had last year, and they were talking about, for example, VC funding drying up, and as a consequence of that, less competition for those who already have a strong moat. Could that possibly justify the difference in pricing, or what else could possibly be that justifies this big
Well,
difference?
are you talking about simply the performance, the outperformance?
Yeah.
Okay, probably the biggest driver of the outperformance is passive investing.
Okay.
So that would just be index investing. So it's become, index investing has grown in popularity, or what we call passive investing. You just put money in the S&P 500, for example, and it's never been as an influential a force as it is today. And what happens in that instance is when you put money, into you're buying more and more of the largest companies, and
Okay.
they continue to grow by that phenomenon alone. It's just the index and the passive investing. And then as they perform well, obviously more money wants to chase the best performers. And we've seen this happen. I went through this in the late 1990s with tech stocks, and they became extremely popular, and everybody wanted to own them, and they were never going to go down. And You
It
could say
didn't,
the same thing about
didn't end
housing.
well. It didn't end well in the 90s.
No, it didn't end well. It's not the same thing though. You know, a lot of people, the bears that are still out there that haven't given up yet, okay? This is what they're pointing at. They're saying this is just like 1999, or this is just like 2019. You know, in 2019 we didn't have the Magnificent Seven, but we had the top five were becoming 20%, growing really fat, large. The difference today is that these companies are massively profitable. They're expensive, but their growth rates, you could argue, warrant it. Okay. Where the problem happens is that when there's any the smallest inkling of a slowdown, which is what we've seen with Tesla in the last couple of months, that there's no mercy. I mean, they'll get, you know, and so you need to have, I think, especially for the companies that are dependent on advertising, like the Googles and the Metas, when you see consumer spending in the US start to slow meaningfully, and the first thing that goes is advertising,
Yeah.
that's when the multiples start to fall. The growth rates fall, the stock prices they'll take a big hit, you know.
Okay.
So everything here really revolves around the consumer. That's what it's about.
Okay. And the last thing I wanted to mention is the money markets that you mentioned earlier. Is it just in the US, or is it foreign capital as well? The graph that you have shown.
You know, that's US, but you know, foreign capital can come in, and I mean, I can buy a 3-month treasury bill and earn the same rate. So it would be cash equivalents. Those are money market balances.
Yeah.
Um, I still think that you're seeing, yeah, sure, you're seeing strong foreign capital inflows because we have positive real interest rates. We have much higher interest rates.
And also, I think that in turbulent times, people prefer um, markets that are considered safer or safe havens
Right.
compared to all the rest of the world. That is,
Yeah.
for example, the Middle East and Eastern Europe.
Yeah. Yeah. That makes, I mean, it's well, and you know, China is now for the first time seeing net foreign outflows, which has never happened in my lifetime. And that means that there's just less competition. So, um, you know, I think that when you judge how the market's going to perform and you use valuations as your metric, it's really dangerous because valuations can stay excessive for a long time. I think what you do as an investor when you see excessive valuations is you look for ones that are not. And so there are there's lots of stocks, there's lots of sectors that where you can invest and you can find really attractive growth rates, but you're paying a lower market than the S&P 500 multiple, which is 20 right now. And the only times the S&P's hit a multiple of 20 forward basis, 1999 and going into the financial crisis. So we're at sort of peak valuations, and that's predominantly because of these Magnificent Seven. The multiples on those companies are closer to 40. So you have more than 30% of the index trading at 40 times. And you have the rest of the market trading at less than 20 times, really more like 16 times. If you take out the Magnificent Seven, the multiple on the S&P 500 is closer to 16, 17. So there's some upside in the rest of the market. The problem is that if you bring down those Magnificent Seven, they usually take everything down with them for a period of time before things rejigger, you know?
Yeah.
So, yeah.
Okay, so I'm done with the questions. So thank you for your availability and your presentation. I think it was very interesting. So if you want to add anything else, feel free to do so. If not, I really want to thank you, Lawrence, for taking the time.
Absolutely. No, that's great. I appreciate it. And look, I look forward to seeing it on your channel.
Okay, great. So this is it for
Thanks.
today. I'm Jacob.
Okay.
This is Hustle Hub. See you next time.